Hello everyone and welcome to another episode of Bullsmart Investment Academy. Till now, we have discussed the basics, working and the types of mutual funds in detail. Now comes the most important part, which is the risk and return. Because I know most of you only care about the risk and return when it comes to investments. So before we move further, one thing that everyone needs to understand is that the risk and return go hand in hand. Not just for investments but in every aspect of life. If you are willing to take high risk, you can get higher rewards. It's like following a tried and tested exercise routine. It will have a moderate impact and there will be less risk. But if you go for aggressive and intense workout program, you will have a much better impact, but there will be a risk of injury. If you leave your 9 to 5 job to start your own business, there will be a risk of little or no income for a while. But if the business becomes successful, you might earn more money that you may never have made while working a 9 to 5 job. Similarly, in mutual funds, if you are willing to take high risk, you may earn a significant amount. But if your risk appetite is low, then you will have to settle for lesser returns. Why does this happen? In mutual funds, equity funds like small cap, mid cap and sectoral funds are considered high risk, as they invest majority of their funds in equities or shares of high-risk companies. But these high-risk companies also have a potential to deliver high returns if market trends are favorable. Low-risk funds like debt mutual funds invest in instruments that promise fixed income returns, like FDs, the favorite instruments of Indian households. But the catch here is they deliver fewer returns, and at times these returns can even go lower than the inflation rate in a fast-growing economy like India. Now let's throw some lights on the types of risk that mutual fund investors are exposed to. And we will also learn how to reduce those risks. Let's start with inflation risk. You might believe there is no risk of investing in FDs, but let me tell you, there is a hidden risk that can reduce the buying power of your money if the return rate is less than the inflation rate. This is called the inflation risk. You might have heard our parents and grandparents saying we used to buy land with less than 10,000 rupees. The same land now costs more than 10 lakhs. Now imagine if they carried the same 10,000 from 1980 to 2003 as cash. Imagine the loss they would have faced doing this. This loss is because of inflation risk. So, if you are not investing your money into a capital market that delivers higher returns than inflation, you are exposing it to inflation risk. Another prevalent risk in mutual funds is the market risk, which comes in the disclaimers, as mutual funds are subject to market risk. So what exactly is this market risk? It's simple. Market risk is the risk of your investments going negative or losing its value because of volatility in the market. It is prevalent in equity mutual funds as the value of stocks keep changing daily for multiple reasons. Diversification is the best measure to reduce the market risk in mutual funds. Another important risk factor is interest rate risk or credit risk, which is prevalent in debt mutual funds. It is the volatility risk due to changes in the interest rates of fixed income instruments. So those were the major risk elements in mutual funds. But remember, there cannot be an investment without risk, and if you are not investing at all, you are exposing your money to a bigger risk. That is inflation and missed opportunities. The risk-return trade-off in mutual funds is more attractive than any other instruments because there is an expert fund manager who is taking care of your investments. So that's a wrap on this episode. Stay tuned for more educational content on mutual funds. Until then, happy investing. Investments in securities market are subject to market risk. Read all the related documents carefully before investing.